The Clarity Act missed its deadline. March 1st came and went. No deal on stablecoin rewards. Headlines say the crypto bill is stuck. Politicians argue. Banks push back. Crypto companies scramble. But here's what almost nobody is explaining. This isn't a delay. It's a negotiation over who gets to control the rules of digital money. And the single issue blocking everything, whether stablecoins can pay rewards, determines who wins the next decade of finance. Because the question sounds technical. Can Circle or Tether or any stablecoin issuer pay you interest for holding their tokens? But that technical question is actually a power question. If crypto companies can pay yield on stablecoins, they compete directly with bank deposits. If they can't, banks keep their monopoly on interest-bearing dollars. So, when you hear deadline missed, what you're actually watching is a fight over who gets to be the bank of the future. And understanding that fight matters more than any prediction about when the bill passes. Because the outcome shapes everything that comes after. If you want to understand how financial systems actually get built, not just how they get marketed, subscribe. Because what comes next breaks down the incentives, the power dynamics, and why this single issue can determine whether crypto integrates into finance or finance absorbs crypto. Let's get into it. Let's start with what actually happened on March 1st. The White House set that date as a target for resolving key stablecoin issues, specifically the rewards question. Banks and crypto companies were supposed to negotiate, find compromise, move forward. March 1st arrives. No agreement. Does that mean the bill failed? No. It means the negotiation continues. Here's why that distinction matters. Legislative processes don't work on hard deadlines unless there's a forcing mechanism like government funding expiring or a debt ceiling. The Clarity Act has momentum, but no existential deadline. March 1st was a White House coordination target, not a statutory requirement. Missing it doesn't kill the bill. It just means the fight isn't resolved yet. So what happens now? The Senate committee prepares for markup, which is the stage where amendments get proposed and negotiated before a full Senate vote. That markup is expected mid to late March. Between now and then, the parties involved, banks, crypto firms, Treasury, Senate staff, try to find language everyone can live with. But let's be clear about what everyone can live with actually means. It doesn't mean everyone's happy. It means both sides accept an outcome they don't love, because the alternative, no bill at all, is worse for everyone. That's how compromise works in practice. Nobody wins completely, but the system moves forward. Now, why does this matter for understanding what's actually happening? Because if you're waiting for a clean victory where crypto companies get everything they want or banks get everything they want, you're waiting for something that won't happen. What you'll get is a negotiated settlement where both sides give up something to get something else, and understanding what each side is willing to give up tells you where the real power lies. So let's dig into the core dispute: stablecoin rewards. What does that even mean? A stablecoin is a digital token pegged to $1. You hold one stablecoin, it's worth $1. The stablecoin issuer, Circle, Tether, whoever, holds reserves backing that token, usually cash or short-term treasuries. Now here's where it gets interesting. Those reserves earn interest. If the issuer holds $1 billion in treasuries yielding 4%, they're making $40 million a year. The question is, do they keep all that interest, or do they share it with the people holding the stablecoins? Crypto companies want to share it. They want to pay rewards to stablecoin holders. Not necessarily all the interest, but enough to make holding stablecoins attractive. Why? Because if you can hold a dollar-pegged token that also earns you 3% yield, why would you keep dollars in a checking account earning 0? Banks oppose this loudly, because if stablecoins pay yield and bank deposits don't, money flows out of banks into stablecoins. That's a direct threat to the deposit base that funds the entire banking system. So the bank's position is simple: no passive yield on stablecoins. If you're just holding them, you don't earn anything. The crypto company's response is to propose workarounds. What if we don't call it yield? What if we call it staking rewards? What if it's a membership program with benefits? What if it's tied to some activity, not just holding? And the bank's response to those workarounds? Still no, because they see through the framing. If it looks like yield, acts like yield, and attracts deposits like yield, it's functionally yield. Calling it something else doesn't change the competitive threat. Now let's talk about why this matters beyond just banks versus crypto companies. Because this fight is actually about the structure of the financial system. Let me explain. Right now, when you deposit money in a bank, the bank pays you interest maybe, if they feel like it, if rates are high enough. That interest comes from the bank lending your deposits out and earning more on loans than they pay you. The gap between what they pay depositors and what they earn on loans is how banks make money. But banks are also regulated. They have to hold capital reserves. They have to follow lending rules. They have deposit insurance through the FDIC. All of that regulation exists because banks create systemic risk. When banks fail, the damage spreads. So society accepts the trade-off. Banks get certain privileges, like FDIC insurance and access to Federal Reserve facilities. In exchange, they accept heavy regulation. Now, stablecoin issuers want to pay yield, but don't want to be regulated as banks. They want the upside, attracting deposits with competitive rates, without the downside, capital requirements, and systemic oversight. From the bank's perspective, that's not fair competition. That's regulatory arbitrage. And from a systemic stability perspective, it's a real question. If trillions of dollars flow out of regulated banks into less regulated stablecoin issuers, what happens during a crisis? Stablecoins backed by treasuries should be safe, but what if there's a run? What if everyone tries to redeem at once? There's no FDIC backstop. There's no lender of last resort. So the banks aren't just protecting their business model. They're also raising genuine concerns about financial stability. Now, whether those concerns are the real motivation or just convenient arguments is debatable. Probably both. But the concerns aren't baseless. The crypto industry's counter-argument is that stablecoins are actually safer than bank deposits because they're fully reserved. Banks operate on fractional reserves. They only hold a fraction of deposits as cash. Stablecoins, at least the major ones, hold one-to-one reserves. Every stablecoin is backed by $1 of assets, so in theory, a stablecoin shouldn't have a run problem. If everyone redeems, the issuer has the assets to pay everyone back, but that assumes the assets are actually there, properly audited and liquid, and those assumptions have been tested before. Tether has faced questions about reserves. Others have faced temporary depegs, so the fully reserved on perfectly safe argument isn't bulletproof either. Let's talk about the federal coordination angle, because this is where the Clarity Act becomes structurally important beyond just the rewards question. Right now, crypto regulation in the US is fragmented. The SEC claims some tokens are securities. The CFTC says some are commodities. Individual states have money transmitter laws that vary wildly. The result is a mess. Companies don't know which rules apply. Compliance is expensive and inconsistent. The Clarity Act aims to create a unified federal framework. It would clarify which agency has jurisdiction over what. It would set standards for stablecoins, issuance, reserves, redemption. It would preempt state money transmitter laws for compliant issuers, meaning if you follow federal rules, you don't need 50 separate state licenses. Why does that matter? Because right now, operating a stablecoin or crypto business in the US requires navigating a regulatory maze. You need different licenses in different states. You face enforcement risk from multiple agencies. You can't get clear answers about what's allowed. A federal framework changes that, not necessarily in a way that makes everything easier, but in a way that makes things predictable. Companies know the rules. They can build compliance infrastructure. They can plan long-term. Investors and institutions can participate without fearing retroactive enforcement. This is why even crypto companies that don't love the bill's specifics still want it to pass. Predictability is valuable. Clarity, even if the rules are stricter than you'd like, is better than ambiguity where anyone can get sued anytime. But here's the tension. Federal clarity also means federal control. If the Clarity Act passes, stablecoin issuers are locked into whatever framework gets negotiated. They can't shop for friendlier state regulators. They can't operate in gray areas. The rules are set, and deviation means enforcement. So the question isn't just whether the bill is good or bad, it's whether the specific rules in the bill, especially on rewards, create conditions for growth or stagnation. And that depends on the details being negotiated right now. Let's talk about the second-order effects, the things that happen if the rewards question gets decided one way versus another, because this is where the incentive structures get really interesting. Scenario 1. Crypto companies win, and stablecoins can pay rewards. What happens? Money flows out of bank deposits into stablecoins. People and companies that were earning 0 or minimal interest in checking accounts move funds into stablecoins earning 3 or 4%. That flow is substantial. Even a small percentage of US deposits moving to stablecoins represents hundreds of billions or trillions over time. For banks, that's a problem. Deposits fund loans. Fewer deposits means less lending capacity. Banks would have to raise deposit rates to compete, which cuts into their profit margins. Or they shrink, which reduces credit availability in the economy. Neither outcome is catastrophic, but both are disruptive. For crypto companies, it's a massive growth opportunity. Stablecoins become not just a tool for crypto trading, but a mainstream savings vehicle. That drives adoption, increases revenue from reserves, and positions stablecoin issuers as central players in the financial system. For consumers, it's better yields and more options. If you can earn 3% on dollars just by holding stablecoins, that's an improvement over current bank account rates. There's risk, not FDIC insured, but for people comfortable with that trade-off, it's a win. Scenario 2. Banks win, and stablecoins cannot pay rewards. What happens? Stablecoins remain useful for payments and crypto trading, but they don't attract deposits away from banks. They're a medium of exchange, not a store of value with yield. Growth continues, but it's slower and more limited to crypto-native use cases. For banks, that preserves the status quo. They keep their deposit base. They maintain control over interest-bearing accounts. The competitive threat from crypto is contained. For crypto companies, it's a loss, but not a death blow. Stablecoins still have utility. Volume still generates revenue. But the big vision, stablecoins as the new form of money that everyone uses because it's better than bank accounts, that vision is capped. For consumers, it means less choice. You don't get the option of a high-yield stablecoin. You're stuck with traditional bank accounts unless you want to take on more risk in other crypto assets. Now, there's also a middle scenario, which is where the negotiation is probably heading. Stablecoins can pay rewards, but only under specific conditions. Maybe rewards are allowed, but capped. Maybe they're only allowed for stablecoins that meet certain reserve standards or operational requirements. Maybe they're structured as something other than direct interest, like loyalty program benefits or activity-based incentives. That middle scenario gives both sides something. Banks get protection from unlimited yield competition. Crypto companies get enough flexibility to offer attractive products. The result is a market where stablecoins can compete, but not completely dominate. Now let's talk about what's happening inside the crypto industry itself, because the external fight with banks isn't the only dynamic shaping this. There are internal tensions too. Coinbase, one of the biggest US crypto exchanges, stepped back from actively lobbying for the Clarity Act. Why? Reportedly because they didn't like some provisions or felt the bill didn't go far enough. That decision hurt the unified industry push. When one of the largest players pulls out, it weakens the collective negotiating position. This is a pattern in crypto, fragmented interests. Companies that should be aligned end up competing or undermining each other. It's part of why crypto struggles to get favorable regulation. The industry can't present a united front. There's also a shift in focus. The early crypto vision was about decentralization, DeFi, peer-to-peer finance, cutting out intermediaries. But the current regulatory fight is almost entirely about stablecoins and centralized issuers. DeFi barely gets mentioned in these negotiations. The conversation has narrowed to who gets to issue dollar-backed tokens and under what rules. That shift reflects where the power and money are. Stablecoins are a massive market. They're integrated with traditional finance. They're something regulators and banks care about. DeFi is harder to regulate, less institutionalized, and therefore gets less attention in these high-level negotiations. For people who got into crypto for the decentralization vision, this is disappointing. The fight that matters, the one that could shape policy for years, is about centralized stablecoins and whether they can pay yield. That's a long way from the original cypherpunk ideals. There's also retail fatigue. The crypto market has been volatile. Meme coins pump and dump, projects launch and collapse, scams proliferate. A lot of retail investors are exhausted. They're not paying attention to regulatory fights. They're either checking out entirely or chasing the next quick gain. This creates a weird dynamic where the most important policy developments are happening while much of the crypto community is distracted or disengaged. The rules being written right now will determine what's possible for years. But the conversation is dominated by insiders, lobbyists, and institutions, not the broader community. Let's bring this back to the core question. Who controls rewards controls adoption. That's the thesis. Let me explain why that's true and why it matters more than the specifics of any single bill. Right now, most people interact with dollars through banks. You get paid, money goes into your bank account. You spend, money comes out of your bank account. Banks are the interface between you and the dollar. They provide services, payments, loans, savings, and they extract value for doing so. If stablecoins can pay yield, they become a competitive alternative to bank accounts. Not a replacement, not immediately, but a real option, especially for people and companies that prioritize yield and don't need traditional banking services like loans. Over time, if adoption grows, stablecoins could become the primary way people hold dollars. Not physical cash, not bank deposits, stablecoins. That shift changes the entire financial system. Banks still exist, but their role changes. They're no longer the default custodians of dollar liquidity. They have to compete on services, not just on being the only option. Now, if banks prevent stablecoins from paying yield, they maintain that custodial role. Stablecoins remain niche tools for specific use cases, mostly within crypto markets. They don't become mainstream money. Banks stay central. So, the fight over rewards is really a fight over the future structure of finance. It's not about technology. Stablecoins work regardless of yield rules. It's about incentives. What do people choose to use? And the answer depends heavily on whether one option pays you and the other doesn't. This is why the negotiation is taking so long. Both sides understand what's at stake. It's not just about one bill or one policy. It's about who gets to be the intermediary for the digital dollar economy. That's worth fighting over. Here's where we land. The Clarity Act isn't stuck. It's negotiating the rules of the next financial system. The March 1st deadline was a coordination target, not a failure point. Negotiations continue. A committee markup is expected in March. Some version of compromise will likely emerge. That compromise will probably disappoint both sides. Banks won't get a complete ban on stablecoin rewards. Crypto companies won't get unlimited freedom to pay whatever yield they want. The result will be something in the middle. Rules that allow some rewards under some conditions, but preserve some competitive protection for banks. Is that the best outcome? Depends on what you value. If you want radical transformation and immediate competition, it's too conservative. If you want stability and gradual change, it's pragmatic. Most likely it's the only outcome that can pass, which makes it the relevant outcome regardless of whether it's optimal. What matters is understanding the incentives and power dynamics at play. This isn't a story about innovation versus regulation. It's not about crypto versus traditional finance. It's about who gets to set the terms for digital money and how much control they retain. Banks have systemic influence, regulatory relationships, and deposit bases to protect. Crypto companies have technology, user bases, and growth potential. The negotiation determines how those assets translate into power over the rules. And those rules, once set, are hard to change. Whatever framework emerges from this fight will shape decisions for years. Stablecoin issuers will build products around it. Banks will adapt strategies based on it. Consumers will make choices influenced by it. That's why this fight matters, even though it's technical and boring and gets almost no attention relative to price movements or hype cycles. This is infrastructure analysis, not investment advice. This is about understanding how systems get built, who has leverage in negotiations, and why single issues like stablecoin rewards can determine structural outcomes. Whether any of this affects short-term markets is unknowable and irrelevant to the core analysis. What matters is recognizing that financial systems don't just evolve naturally. they're negotiated, and right now, that negotiation is happening. If this reframed how you think about crypto regulation and what these policy fights actually mean, subscribe. We're here to explain power dynamics and incentive structures, not to predict outcomes or tell you what to do. Drop a comment if you're seeing connections you hadn't considered before. Let's talk about how financial systems actually get built when nobody's watching the technical details. Because the fight nobody's watching is the fight that decides everything. And understanding that is worth more than any prediction about when the bill passes or what happens next quarter. Three forces are converging right now. The Clarity Act is moving through Congress, potentially legalizing stablecoins for banks within months. The U.S. Treasury is preparing to issue $12 trillion in short-term debt over the next 6 months. And geopolitical conflict just escalated in a way that's sending capital into defensive positions globally. Most people see these as separate headlines. Crypto regulation, treasury markets, war developments. But they're not separate. They're interconnected systems that shape how capital flows, where risk lives, and what happens to markets when they collide. Here's what almost nobody is explaining. These three forces don't just coexist. They interact. Regulation changes what's legal. Liquidity changes what's possible. Geopolitics changes what's preferable. And when all three move at once, markets don't behave the way headlines predict. They behave the way systems respond under stress. If you want to understand how markets actually work when multiple forces converge simultaneously, subscribe. Because what comes next is going to reframe how you think about what's happening right now. Let's break down each force, then examine what happens when they intersect. Let's start with the Clarity Act because this is the regulatory shift everyone's watching. The legislation aims to provide a clear framework for digital assets in the United States. Specifically, it addresses stablecoins, giving banks explicit permission to issue, hold, and transact with them under federal oversight. Why does that matter? Because right now, the regulatory status of stablecoins is ambiguous. Some agencies treat them as securities. Others treat them as commodities. Banks don't want to touch something that might trigger enforcement action 3 years from now. That ambiguity has kept institutional capital on the sidelines. The Clarity Act would remove that ambiguity. It would establish licensing requirements, reserve standards, and operational guidelines. Banks could integrate stablecoins into their systems without fearing retroactive prosecution. That opens the door for massive institutional participation. Estimates suggest the bill has an 80 to 90% chance of passing, but there are sticking points. One major debate centers on yield. Should stablecoin issuers be allowed to pay interest to holders? Banks argue that if they can't offer yield, they're at a competitive disadvantage compared to non-bank stablecoin issuers. Non-bank issuers argue that forcing them to become chartered banks creates barriers to entry. This isn't just a technical dispute. It's a structural question about who controls the future of digital payments. If banks dominate, the system looks centralized and heavily regulated. If tech companies dominate, the system looks decentralized but potentially unstable. The compromise being negotiated will determine which path wins. Standard Chartered noted that the debate has shifted from whether banks will participate to how they'll participate. That's a significant change in tone. It signals that institutional adoption is no longer hypothetical. It's imminent, pending final regulatory clarity. Timeline matters here. The White House set a deadline of March 1st for finalizing key provisions. If that deadline is met, banks could begin integrating stablecoins into their infrastructure by mid-year. If it's delayed, uncertainty persists, and capital stays cautious. The takeaway? Regulation isn't just legal paperwork. It's the infrastructure that determines whether trillions of institutional dollars can flow into digital assets or remain locked out. And right now, that infrastructure is being built. Now let's add the second force, Treasury issuance. Over the next 6 to 7 months, the U.S. government plans to issue $12.2 trillion in short-term Treasury securities. That's not a typo. $12 trillion. For context, the entire quantitative easing program during COVID was $4.8 trillion over 2 years. This is more than double that, compressed into half a year. Why so much issuance? Because the government is rolling over existing debt and financing ongoing deficits. Short-term bills mature quickly, so they need constant refinancing. As interest rates have risen, the cost of servicing that debt has increased, which creates a feedback loop. More borrowing to cover interest payments on previous borrowing. But here's where it gets interesting for markets. Where does the money come from to buy 12 trillion in treasuries? There are two main sources: money market funds and existing asset holders. Money market funds currently hold trillions in assets. When new treasury bills are issued, those funds buy them. That's relatively neutral for risk assets because the money was already sitting in cash equivalents. But if money market fund balances are stable or declining, the treasury has to attract buyers from elsewhere. That means investors selling stocks, bonds, or other risk assets to buy treasuries. When that happens, liquidity drains from risk assets and flows into safe assets. That's contractionary. It tightens financial conditions. Now layer in the Federal Reserve's position. The Fed has been shrinking its balance sheet, letting treasuries mature without reinvesting. That's quantitative tightening. It removes liquidity from the system. If the Treasury is issuing massive amounts while the Fed is withdrawing support, you get a liquidity squeeze. This matters for crypto because digital assets are risk assets. When liquidity tightens, risk assets sell off. When liquidity expands, they rally. The 12 trillion question isn't just about treasuries. It's about whether that issuance absorbs liquidity from other markets or whether new money enters the system to buy them. If money market balances stay high, the issuance is absorbed smoothly. If they fall, something else has to be sold. And historically, crypto sells first because it's the most liquid, most volatile, and least institutionally embedded asset class. Third force, geopolitical conflict. Recent developments have escalated tensions in multiple regions. Markets react to geopolitical risk in predictable ways. Capital flows out of risk assets and into defensive positions. U.S. Treasuries, gold, the dollar. These are safe havens when uncertainty spikes. This is not a political commentary. It's a mechanical observation. When geopolitical risk rises, investors reduce exposure to assets that could experience sharp drawdowns. Crypto is high on that list. Equities come next. Corporate bonds follow. The flight to safety is a structural response, not an emotional one. But here's the nuance. Markets often overreact to geopolitical events in the short term and underreact in the long term. The immediate response is fear-driven. Sell everything risky. Buy everything safe. But over weeks and months, markets reassess. If the conflict doesn't escalate into full systemic disruption, capital flows back into risk assets. If it does escalate, the defensive positioning persists. The challenge for anyone trying to understand market behavior right now is separating the noise from the signal. Geopolitical headlines create volatility, but that volatility doesn't necessarily indicate a new trend. It indicates uncertainty, and uncertainty resolves. The question is whether it resolves through de-escalation or through adaptation to a new baseline risk level. For crypto specifically, geopolitical risk creates selling pressure in the short term but doesn't change the long-term adoption trajectory. Institutions building stablecoin infrastructure don't stop because of a conflict. Regulatory frameworks don't disappear. Technology development continues. What changes is the timing and the sentiment. And those are temporary factors unless the conflict fundamentally alters global financial architecture. Now let's examine what happens when these three forces intersect, because this is where understanding systems becomes more valuable than reacting to headlines. Force 1 is regulatory clarity. If the Clarity Act passes, it legitimizes stablecoins and invites institutional participation. That strengthens the structural framework over time because it expands the addressable market. More participants, more capital, more use cases. Force 2 is treasury issuance. 12 trillion in supply creates demand for liquidity. If that demand drains capital from risk assets, it creates short-term pressure. If it's absorbed by existing cash balances, it has neutral impact. The outcome depends on where the money comes from. Force 3 is geopolitical risk. Conflict drives capital into safety. That creates pressure on risk assets in the short term. But it also increases demand for decentralized alternatives to traditional finance, which can support crypto adoption structurally over time. So how do these interact? If regulatory clarity passes while liquidity is tight and geopolitical risk is high, you get a mixed signal. Strengthen structure. Tighten conditions. The market might sell off despite positive regulatory news because near-term liquidity and risk sentiment override long-term fundamentals. Alternatively, if liquidity improves and geopolitical risk fades while regulation passes, you get alignment. Strengthened structure, improved conditions, positive sentiment. That's when markets move decisively. The mistake most people make is treating each force in isolation. They see the Clarity Act and assume crypto rallies. They see Treasury issuance and assume crypto sells. They see geopolitical conflict and assume everything crashes. But markets don't respond to single inputs. They respond to the interaction of multiple inputs across different time frames. Understanding that interaction requires thinking in systems, not stories. Stories are linear. Regulation passes, price goes up. Systems are dynamic. Regulation passes, but liquidity is tight, so price consolidates. Then liquidity improves, and price catches up to the regulatory shift. Let's dig deeper into liquidity specifically, because this is the force most people misunderstand. Liquidity isn't just money in the system. It's the availability of capital to flow into assets without causing disruptive price moves. When liquidity is high, markets absorb buying and selling smoothly. When liquidity is low, small flows cause large price swings. The $12 trillion in Treasury issuance tests liquidity. If buyers exist without sellers of other assets, liquidity is fine. If buyers only exist when other assets are sold, liquidity tightens. The Federal Reserve's quantitative tightening compounds this because the Fed was the largest buyer of treasuries for years. Without Fed demand, private sector demand has to fill the gap. Here's where stablecoins enter the picture. If the Clarity Act passes and banks issue stablecoins at scale, those stablecoins represent new liquidity. They're dollar-denominated. They settle instantly. They're blockchain native. That makes them useful for payments, settlements, and collateral. And if they're useful, demand for them grows. Growing stablecoin demand means capital flowing into stablecoin reserves. Those reserves are often held in short-term treasuries or cash equivalents. So stablecoin growth could actually help absorb treasury issuance without draining liquidity from risk assets. It creates a new source of demand for safe assets that doesn't compete with risk assets directly. This is a positive feedback loop. More stablecoins mean more treasury demand. More treasury demand means smoother issuance. Smoother issuance means less liquidity pressure on risk assets. Less pressure means improved conditions for crypto. And improved conditions for crypto mean more use cases for stablecoins. The loop reinforces itself. But that only works if stablecoins are legal and banks can issue them. Without the Clarity Act, this loop doesn't start. Capital stays in traditional structures. Treasury issuance competes with risk assets for liquidity. And crypto faces headwinds. This is why regulatory clarity and treasury issuance aren't separate stories. They're connected through liquidity dynamics. One creates supply. The other could create demand. Whether they balance or clash determines market conditions. Now let's address the geopolitical component more directly. Conflict doesn't just create fear. It creates structural shifts in how capital is allocated globally. When geopolitical risk rises, countries and institutions reassess their exposure to systems controlled by potential adversaries. That includes financial systems. This has implications for decentralized finance. If traditional financial infrastructure is perceived as vulnerable to geopolitical disruption, alternatives become more attractive. Blockchain-based systems don't rely on single points of control. They don't freeze accounts based on political decisions. They operate according to code, not policy. That's both a strength and a weakness. The strength is resilience. The weakness is lack of recourse. If you lose access to traditional finance, you can appeal to authorities. If you lose access to a decentralized system because you lost your private key, there's no appeal. Different risks. Different trade-offs. But in a world where geopolitical conflict threatens financial access, those trade-offs shift. The risk of political exclusion from traditional systems rises. The relative attractiveness of decentralized alternatives rises with it. That doesn't mean overnight adoption. It means gradual structural shifts over years. The interesting dynamic is that geopolitical conflict creates short-term fear, but long-term demand for alternatives. In the immediate aftermath of escalation, capital flees risk. But over time, as the conflict persists or becomes normalized, capital flows into systems that reduce exposure to geopolitical risk. Decentralized finance qualifies. This is why geopolitical risk creates pressure on crypto in the short term while potentially supporting long-term adoption. Short-term pressure because it's a risk asset. Long-term structural support because it's a hedge against centralized system vulnerability. The timing of those effects determines whether markets move up or down at any given moment. So where does that leave us practically? How should you think about markets when three major forces are converging simultaneously? First, recognize that short-term and long-term dynamics often conflict. Regulatory clarity strengthens long-term structure. Liquidity tightness creates short-term pressure. Geopolitical risk creates short-term pressure but builds long-term demand for alternatives. Markets oscillate between these time frames. Understanding which dominates at any moment helps you interpret price action without overreacting. Second, watch liquidity indicators more than headlines. Money market fund balances, Treasury auction results, Federal Reserve balance sheet changes. These metrics tell you whether liquidity is expanding or contracting. That's more predictive than news about regulations or conflicts because liquidity is the fuel that moves all assets. Third, distinguish between structural shifts and cyclical volatility. The Clarity Act is structural. It changes what's legal and who can participate. Treasury issuance is cyclical. It happens regularly. Geopolitical conflict can be either. If it resolves quickly, it's cyclical volatility. If it restructures global finance, it's structural. Fourth, avoid binary thinking. Markets don't go straight up or straight down. They react to forces, digest information, and reprice based on probabilities. When multiple forces pull in different directions, markets chop. That's not weakness. That's complexity being processed. Fifth, understand that most participants are reacting emotionally to each headline without considering how the forces interact. When you see panic over geopolitical developments, ask whether anything structural changed or whether it's just volatility. When you see euphoria over regulatory news, ask whether liquidity conditions support a sustained move or whether it's just a short-term sentiment shift. And finally, remember that systems take time to adjust. Even if the Clarity Act passes tomorrow, banks don't integrate stablecoins overnight. Infrastructure takes months to build. Compliance takes time to implement. The market often front-runs the actual adoption, rallies on the news, then consolidates during the execution phase. That's normal. It's not a failed prediction. It's how adoption actually unfolds. If this changed how you think about markets when multiple forces converge, subscribe. We're here to teach systems thinking, not headline reactions. We're here to explain how regulation, liquidity, and geopolitics interact, not to predict what happens next. Drop a comment if you're seeing connections between these forces that you hadn't considered before. Let's talk about how complexity works in real time. Because the goal isn't to eliminate uncertainty. It's to understand how systems respond to it. Markets are complex adaptive systems. They don't follow linear logic. They respond to the interaction of forces across different time frames. Learning to think in those terms makes you resilient to volatility instead of paralyzed by it. Regulation sets the structure. Liquidity determines the flow. Geopolitics shifts the priorities. All three are moving right now. And understanding how they intersect is worth more than any single prediction about what happens next. Because predictions fail, systems thinking endures. And right now, that's the skill that matters most. BlackRock wants to tokenize trillions in ETFs, $5.5 trillion worth of funds potentially moving on-chain within 3 to 12 months. That sounds like DeFi 1, like blockchain finally conquered traditional finance, like the revolution arrived. But it might actually mean the opposite, because when the world's largest asset manager adopts blockchain technology, they're not joining the crypto movement, they're absorbing it. They're rebuilding traditional finance on blockchain rails, on their terms, under their control. And understanding that distinction changes everything, because this isn't decentralization winning. This is Wall Street adapting. And when Wall Street adapts, it doesn't surrender power. It consolidates it using better technology. If you want to understand what happens when traditional finance moves on-chain without giving up control, subscribe. Because what comes next reframes the entire narrative around institutional blockchain adoption. Let's break down what's really happening here. First, let's be clear about what tokenization actually means, because the word gets thrown around like it's magic, but it's just technology. Tokenization means representing an asset as a digital token on a blockchain. Instead of owning shares of an ETF through a traditional brokerage, you'd own tokens representing those shares that exist on-chain. What does that enable? Several things. 24/7 trading. Traditional markets close. Blockchain markets don't. If your ETF is tokenized, you can theoretically trade it at any time. Fractional ownership becomes easier. You can own 0.001 of a token instead of needing to buy whole shares. Collateral usage in DeFi. Tokenized assets can be used as collateral in lending protocols, yield strategies, and other decentralized finance applications. And settlement efficiency. Blockchain settlement is near instant compared to the T+2 settlement cycle in traditional markets. Those are real improvements. They're not hype. Tokenization does change infrastructure in meaningful ways, but here's what tokenization doesn't automatically change: ownership structure, control mechanisms, regulatory oversight, access restrictions. BlackRock tokenizing their ETFs doesn't mean those ETFs become permissionless. It doesn't mean anyone anywhere can buy them without KYC. It doesn't mean regulators lose oversight. It means BlackRock uses blockchain as the back-end infrastructure while maintaining all the traditional finance controls on the front end. Think about it like this. Email moved communication onto the internet, but corporate email didn't become permissionless and decentralized. Companies run email servers with access controls, monitoring, and compliance layers. The technology is internet-based, but the system remains controlled. BlackRock's tokenization will likely follow the same pattern. Blockchain technology, traditional finance control. The plumbing changes. The power structure doesn't. Now let's talk about what this means for the blockchain ecosystems themselves. BlackRock has indicated that Ethereum will be a primary chain for tokenization. That makes sense. Ethereum has the most developed infrastructure for tokenized assets. It has liquidity. It has institutional-grade tooling. It has regulatory familiarity. But the vision includes a multi-chain approach. Assets could exist on multiple blockchains simultaneously, with bridges and interoperability protocols connecting them. That's where other chains like XRP, Solana, and others could play roles. For XRP specifically, the pitch is cross-border settlement efficiency. XRP Ledger is designed for fast, low-cost international transfers. If tokenized ETFs need to move between different markets or currencies, XRP could theoretically serve as a bridge asset. Ripple has been building relationships with financial institutions for years. State Street is working with Ripple. There are integrations being tested. But let's be realistic about what that means. XRP could benefit structurally, but only if routing design, liquidity depth, institutional preference, and regulatory alignment all favor its integration. That outcome is not guaranteed. XRP is one possible infrastructure layer among many. At present, Ethereum remains the most institutionally integrated blockchain for tokenization. Any alternative chain would need to demonstrate measurable advantages in efficiency, liquidity, security, and regulatory compatibility at scale. Stablecoins already handle most on-chain value transfer. Central bank digital currencies are being developed that could serve the same bridge function XRP targets. So while XRP could benefit from institutional tokenization, the competition is intense. And institutions will use whatever infrastructure works best for their specific needs. They're not loyal to any one blockchain. They're pragmatic. If Ethereum is cheaper and more liquid for a specific use case, they'll use Ethereum. If XRP offers advantages elsewhere, they'll use XRP there. The multi-chain future means every blockchain is competing for specific use cases, not dominance across all use cases. And that competition is decided by performance, cost, and institutional relationships, not by community narratives. Let's zoom out and examine the power dynamic here, because this is where the story gets more complex than institutions adopt blockchain equals crypto wins. BlackRock manages $5.5 trillion. Morgan Stanley just applied for a digital custody license that would allow them to hold and manage digital assets under full regulatory oversight. The Clarity Act, if it passes, would create explicit legal frameworks for stablecoins and digital assets in the US. Put those pieces together and you get a picture. Traditional finance is building the infrastructure to operate on-chain while maintaining institutional control. They're not dismantling themselves. They're upgrading their technology stack. What does that look like in practice? Tokenized ETFs that trade 24/7, but only through approved custodians and broker-dealers. Blockchain settlement that's instant, but with compliance layers that monitor every transaction. DeFi integration, but only for accredited investors and regulated entities. Stablecoins, but issued by banks and subject to the same oversight as traditional deposits. This is not the permissionless, decentralized vision that early crypto advocates imagined. This is permissioned blockchain, private chains or public chains with access controls, technology borrowed from crypto, values inherited from traditional finance. And here's the uncomfortable question. Is that a win for blockchain adoption or a loss for decentralization? Because both can be true simultaneously. Blockchain usage expands massively, but it expands in forms that replicate existing power structures rather than disrupt them. Now let's talk about Asia, because this is where the numbers get dramatic. Susan Chan, BlackRock's head of Asia Pacific, noted that Asian household wealth totals about $108 trillion. If just 1% of that were allocated to digital assets, it would represent over $2 trillion flowing into blockchain markets. That's a massive number, and it's being cited everywhere as evidence that institutional capital is coming. But let's be careful about how we interpret this. 108 trillion is total wealth, not liquid investable assets, not capital sitting idle waiting for allocation. It's the aggregate value of all household wealth across an entire continent. Saying 1% could be allocated is hypothetical. It's a calculation, not a forecast. It shows potential scale, not guaranteed flow. And even if some portion of that wealth does move into digital assets, it won't happen overnight. It will happen gradually, over years, as regulations clarify, infrastructure matures, and institutions build confidence. So when you hear numbers like $2 trillion, understand them as potential capital pools, not imminent inflows. The difference matters because potential creates long-term structural growth opportunities, while imminent inflows create short-term price expectations that often disappoint when the timeline stretches longer than anticipated. Asia is a major market. Wealth is concentrated there. Adoption is accelerating. But adoption curves are measured in years, not quarters. And confusing potential with certainty leads to misaligned expectations. Let's bring this back to the core tension. Traditional finance adopting blockchain technology is structurally positive for the technology. It validates that blockchain infrastructure solves real problems. It drives development, liquidity, and legitimacy. But it also means traditional finance absorbs blockchain on its own terms. When BlackRock tokenizes ETFs, they're not decentralizing. They're using decentralized technology in centralized systems. When Morgan Stanley gets digital custody licenses, they're not eliminating intermediaries. They're becoming the intermediaries for digital assets. When banks issue stablecoins, they're not embracing permissionless money. They're digitizing fiat under regulatory supervision. This creates a paradox. Blockchain adoption accelerates. But the ethos that originally drove blockchain development, permissionless access, censorship resistance, individual sovereignty, gets diluted. The technology spreads, the values don't. Is that bad? It depends on what you value. If you care about blockchain as a technology that improves efficiency, then institutional adoption is unambiguously positive. Better settlement, lower costs, more accessibility to tokenized assets. If you care about blockchain as a tool for decentralization and freedom from institutional control, then this version of adoption is more complicated. The institutions aren't adopting your version of blockchain, they're creating theirs, and theirs will likely be bigger, more liquid, and more integrated with existing systems. But it will also be more controlled, more regulated, and more aligned with traditional power structures. So where does that leave individual participants? If institutional blockchain adoption means permissioned systems and controlled access, What's the path for people who wanted something different? The answer is that both versions will coexist. Permissioned institutional blockchain and permissionless public blockchain will operate in parallel. Institutions will use private or permissioned chains for activities that require compliance and oversight. Public chains will continue serving use cases that prioritize decentralization and openness, and there will be bridges between them. Stablecoins might originate from banks on permissioned chains but flow into public DeFi protocols. Tokenized assets might start on institutional platforms but eventually integrate with decentralized exchanges. The boundary between permissioned and permissionless won't be absolute, but the balance of power matters. If the majority of capital and activity flows through institutional permission systems, then public chains become niche alternatives rather than dominant infrastructure. They don't disappear. They just serve different use cases for different users. This is why framing matters. If you think BlackRock tokenizing ETFs means crypto won, you might be disappointed when the tokenized ETFs look and feel like traditional finance with blockchain plumbing. If you understand it as traditional finance adopting useful technology while maintaining control, your expectations align with what's actually being built. Here's the final reality check. This isn't a crypto takeover. It's a financial system transition. And transitions are negotiated, not explosive. Traditional finance doesn't surrender to crypto. It borrows what works and integrates it into existing structures. That process benefits blockchain technology. It drives development, standardization, and scale. But it doesn't guarantee that the values motivating early blockchain adoption, decentralization, permissionless access, individual sovereignty, dominate the final outcome. What we're seeing is institutional blockchain, not decentralized blockchain. And understanding that distinction protects you from false expectations. You won't mistake institutional adoption for revolutionary change. You won't confuse tokenization for decentralization. You won't assume that because BlackRock uses blockchain, power dynamics have shifted. Power dynamics shift slowly. Technology adoption happens faster, and the gap between those two timelines is where narratives break down, because the story sounds transformative. 5 trillion on-chain, trillions from Asia, Morgan Stanley custody, Clarity Act passing, but the structure underneath might look remarkably similar to what existed before, just running on better infrastructure. If this changed how you think about institutional blockchain adoption and what it actually means, subscribe. We're here to separate technology adoption from power shifts, infrastructure upgrades from systemic change. Drop a comment if you're noticing the difference between blockchain as technology and blockchain as movement. Let's talk about what happens when one succeeds without the other. This is infrastructure analysis, not a price forecast or investment thesis. Tokenization changes plumbing. Whether it changes power depends on how institutions design and control the systems they build. And right now, they're designing systems that preserve their position while improving their tools. That's smart adaptation, but it's not revolution. And knowing the difference is what separates clear thinking from narrative-driven expectations. Ripple is flipping the switch. That's the narrative. One moment, traditional finance operates on old rails. The next moment, the claim is that everything will suddenly run on XRP. Instant global payments, tokenized assets, banks integrated, the future turned on. Except that's not how infrastructure works. There is no switch. There's no single moment where legacy systems disappear and blockchain takes over. What's actually happening is hundreds of small integrations stacking on top of each other. Partnerships, pilot programs, compliance frameworks, licensing approvals. Each one is a piece of infrastructure being rewired, not a switch being flipped. And understanding that difference changes everything. Because if you're waiting for one big moment, you'll miss what's actually happening. Slow, operational, institutional adoption that doesn't look dramatic but quietly rebuilds how money moves. If you want to understand what institutional integration actually looks like versus what the marketing says it looks like, subscribe. Because what comes next breaks down the difference between narrative and infrastructure. Let's examine what's really being built here. Let's start with the phrase itself. Flip the switch. It implies simplicity. One action. Immediate transformation. Brad Garlinghouse, Ripple's CEO, used this language but then clarified. It's not one switch. It's thousands of switches, thousands of small moments where a bank integrates, a payment processor adopts, a regulator approves, a custodian onboards. That clarification is critical because it reframes expectations. If you're expecting a single announcement that changes everything overnight, you're going to be disappointed. That's not how complex systems transition. Legacy financial infrastructure took decades to build. It's not replaced in a quarter. It's not replaced in a year. It's slowly integrated, tested, and adapted over long time frames. So what are these switches? Let's break them down by category because not all partnerships mean the same thing. First category is custody and settlement infrastructure. BNY Mellon was selected as the primary custodian for Ripple's stablecoin reserves. BNY Mellon manages $55 trillion in assets. That's real infrastructure. That's not a pilot. That's a major financial institution choosing to hold reserves for a blockchain-based stablecoin. Why does that matter? Because custody is foundational. Institutions won't use stablecoins unless reserves are held by trusted entities with proper oversight. BNY Mellon provides that trust layer. This signals institutional exploration of blockchain-based stablecoins being structured with traditional finance standards. But notice what this doesn't do. It doesn't make XRP the settlement layer for global finance. It doesn't mean banks are suddenly transacting in XRP. It means one piece of infrastructure, stablecoin custody, has been integrated with a major player. That's operational progress for Ripple's stablecoin infrastructure. It's not systemic transformation. Second category is banking integrations. DXC Hogan is a core banking platform used by institutions managing over 300 million accounts and $5 trillion in deposits. Ripple integrated with this platform, meaning banks using DXC Hogan can now connect to Ripple's payment rails without overhauling their entire system. This reduces friction for testing and pilot programs, but does not guarantee scaled adoption. Banks don't have to rebuild infrastructure to test Ripple's technology. They can plug in. That lowers the barrier to experimentation, but it doesn't force adoption. It makes it easier. There's a difference. Banks that integrate this way can run pilots. They can test cross-border payments on Ripple's network alongside their existing SWIFT transactions. They can compare cost, speed, and reliability. And based on those tests, they decide whether to expand usage or stay with traditional rails. This is how institutional adoption actually works. It's not a mandate. It's optionality. And optionality takes time to convert into scale. Some banks will adopt quickly. Others will test for years. Some will never fully transition because their existing systems work well enough. The integration with DXC Hogan is infrastructure that enables testing. It's a piece of the puzzle, but it's not proof of future adoption at scale. Third category is liquidity and trading infrastructure. Ripple Prime, which acquired Hidden Road, processes around $3 trillion annually. With the Hidden Road acquisition, that capacity expands to $44 billion daily in institutional trading volume. This is about building liquidity rails. Institutional traders need deep, liquid markets to move large positions without slippage. Ripple Prime provides that for digital assets. It allows hedge funds, asset managers, and proprietary trading firms to access crypto markets with the infrastructure they're used to in traditional finance. But here's the key question. Does Ripple Prime's liquidity infrastructure require XRP? Not necessarily. The platform supports multiple digital assets. XRP is one of them. It's not the only one. The value of Ripple Prime is that it makes digital asset trading more accessible to institutions. Whether those institutions use XRP specifically depends on whether XRP solves a problem for them that other assets don't. For cross-border payments, XRP has a use case. It's fast. It's cheap. It's designed as a bridge currency. But for institutions trading Bitcoin, Ethereum, or stablecoins, Ripple Prime is just infrastructure. It's not an XRP adoption driver unless the use case demands XRP. So Ripple Prime is valuable. It's real, but it's not automatically XRP-centric. It's liquidity infrastructure that supports the broader ecosystem. Fourth category is tokenization and institutional investment. Franklin Templeton, managing $1.7 trillion in assets, is a funding partner for XRPL ecosystem programs. Aviva Investors, with $300 billion in assets, is exploring tokenized investment products on XRP Ledger. Tokenization is the process of representing real-world assets as blockchain tokens. Real estate, bonds, equity, commodities. The pitch is that tokenization creates efficiency, faster settlement, fractional ownership, global access. XRP Ledger is positioning itself as a platform for this. Franklin Templeton and Aviva participating signals that major asset managers see potential. But potential is not deployment. These are exploratory partnerships. They're testing infrastructure. They're evaluating whether tokenization on XRPL offers advantages over tokenization on other chains or traditional systems. And here's the reality. Tokenization has been talked about for years. The technology works. But adoption is slow because regulation is unclear, market structure is fragmented, and institutional demand is cautious. Asset managers don't tokenize billions overnight. They run pilots. They test compliance. They wait for regulatory clarity. So Franklin Templeton and Aviva are positive signals. They indicate XRPL is being considered seriously. But they're not proof that tokenization on XRPL will dominate. They're proof that it's in the conversation. Fifth category is stablecoin expansion. Multiple institutions are issuing stablecoins on XRP Ledger. JPYC in Japan. Euro-denominated stablecoins in Europe. Stablecoins tied to local currencies in Brazil and other markets. This is important because stablecoins are the most practical use case for blockchain and payments. They're stable. They're familiar. They represent existing currencies digitally. And if stablecoins are issued on XRPL, that creates native activity on the network. But again, let's be specific about what this means. Issuing a stablecoin on XRPL doesn't require using XRP for transactions. Stablecoins can transact on the ledger using those stablecoins as the medium of exchange. XRP is used for network fees, which are minimal. So stablecoin growth on XRPL increases network activity, but doesn't necessarily create demand for XRP itself. Now, if XRP is used as a bridge currency between stablecoins, that's different. If a payment needs to convert from a yen stablecoin to a euro stablecoin and uses XRP as the intermediary, that creates utility. But that's a design choice, not a default. It depends on whether the liquidity and routing algorithms favor XRP as the bridge or whether direct stablecoin to stablecoin swaps are more efficient. So stablecoin expansion on XRPL is real growth. It's adoption, but it's not automatic XRP adoption. It's infrastructure that could support XRP use cases if designed that way. Sixth category is regulatory and licensing progress. Ripple received conditional approval for a U.S. banking charter. This allows Ripple to operate as a regulated financial institution, participating in markets like the repo market and offering services that require banking licenses. This is a big deal structurally. It means Ripple is integrating into the regulated financial system, not operating parallel to it. Regulatory approval gives institutions confidence. It signals that Ripple is playing by the rules, which reduces compliance risk for partners. But notice what this doesn't guarantee. It doesn't guarantee that banks will choose Ripple's technology over alternatives. It doesn't guarantee that XRP becomes a widely adopted settlement asset. It guarantees that Ripple can participate in regulated markets. That's access, not dominance. And licensing takes time. Conditional approval means requirements must be met. Final approval could take months. And even after approval, building out banking operations takes years. This is infrastructure work. It's foundational, but it's slow. Seventh category is the SWIFT comparison. Ripple is working with Consensus, the organization behind SWIFT, to explore interoperability between blockchain and traditional messaging systems. SWIFT isn't going away. It's exploring how to integrate blockchain technology into its existing infrastructure. This is often framed as Ripple replacing SWIFT. That's not what's happening. SWIFT is exploring how blockchain can enhance its systems. Ripple is one of several blockchain companies in those conversations. If SWIFT adopts blockchain technology, it might use Ripple's solutions, or it might use Ethereum, or a consortium chain, or its own technology. The point is, SWIFT collaboration is not SWIFT capitulation. It's SWIFT adaptation, and that adaptation may or may not center around XRP. The collaboration signals that blockchain is being taken seriously by legacy infrastructure, but it doesn't determine which blockchain wins. So after examining all these categories, what do we actually have? We have real infrastructure being built. custody with BNY Mellon, banking integrations with DXC Hogan, liquidity infrastructure with Ripple Prime, asset manager participation through Franklin Templeton and Aviva, stablecoin issuance across multiple currencies, regulatory approval progress, conversations with SWIFT. Each of these is a piece. Each one matters. But none of them is the switch. None of them transforms the entire system overnight. What's happening is gradual integration. Ripple is building infrastructure that allows traditional finance to interact with blockchain-based systems. Some institutions will adopt quickly. Others will test slowly. Some will never fully transition. This is how complex systems change. Not through revolution. Through evolution. Piece by piece. Integration by integration. And that process takes years, sometimes decades. The internet didn't replace traditional media overnight. It took 20 years. Email didn't replace physical mail instantly. Cloud computing didn't replace on-premise servers in a quarter. Blockchain integration into finance will follow the same pattern. Slow, operational, incremental. And the institutions leading that integration, like Ripple, are building the rails that make it possible. But rails don't force adoption. They enable it. Adoption depends on whether institutions find the new rails better than the old ones. Cost, speed, reliability, compliance. All of those factors determine whether the infrastructure gets used at scale. So when you hear about partnerships and integrations, ask what's actually being built. Is it a pilot? Is it full deployment? Is it exploratory? Is it operational? Those distinctions matter because they separate narrative from reality. If this changed how you think about infrastructure versus transformation, subscribe. We're here to explain what's actually being built, not what marketing says is being built. Drop a comment if you've noticed the difference between incremental progress and the narratives around it. Let's talk about how to evaluate infrastructure development critically. Because the goal isn't to dismiss progress, it's to understand it accurately. Ripple is building real infrastructure, but infrastructure takes time. And understanding that timeline protects you from false expectations. This isn't a switch. It's a system being rewired piece by piece. And that process doesn't happen in headlines. It happens in boardrooms, pilot programs, and compliance reviews. Slowly, deliberately, and only time reveals whether it succeeds.